Hey, this is Kyrill Asatur, and this is Centerfin's Collective Weekly for the week ending May 3rd, 2024. This week, we're going to actually break down April's market performance. We usually don't do this, but it highlighted some trends that we've been talking about for a while. The second thing we'll talk about is the Fed, which had its meeting this week, so it's a very important event, but we'll actually highlight why we think the Fed may be not as important as it has been in the past. And then last but not least, we had the jobs number on Friday this morning, and the market has reacted very positively to that. It's looked at by many right now as a Goldilocks type number. So we'll break down what that means and what we think about it going forward. So starting with the stock market. So April was not a good month for the stock market. The S&P 500 was down over 4%, gave back about 40% of its gains in the first quarter. In the first quarter, the S&P was up 10%. So it was a pretty bad month. Smaller cap stocks were down over 6%, almost 7%. And as of the end of April, we're actually down on the year. Tech stocks were not immune. Tech stocks were down over 4% for the month. And the more highly speculative parts of the market, for instance, biotechs were down 10%. And crypto was not immune either. Bitcoin was down almost 25% for the month. Bad month for risk assets. That should mean that bonds actually did well because generally speaking, historically, bonds do well when stocks do poorly. But bonds didn't do well either last month because yields were higher. Bonds were actually down about 4% as well. So stocks and bonds down. Risk assets are down across the board. Historically, the correlation between stocks and bonds and why most portfolios are allocated to a mix of stocks and bonds is because they are negatively correlated to each other. But something we've talked about for the last year and change is that may not be the case in this kind of post-COVID, higher inflation, higher interest rate world that we're living in, which is a very different environment than we were in the couple of decades preceding COVID. And so what was up for the month, actually? Like, where could you hide for the month? Commodities. So gold, silver, copper were all higher on the month. That was really the only place where there were returns to be made. As we've talked about before, we think going forward, the allocation to a typical 60-40 portfolio might make less sense than it has in the past. And things like hard assets, commodities might be a better hedge to the stock portion of client portfolios. And we highlight April. We usually don't focus on kind of monthly returns because that's short-term focus. But it did highlight a trend that we've been talking about for a while, so we wanted to bring to your guys' attention. Next up, the Fed. So the Fed met this week. It was highly anticipated that they wouldn't do anything, and they didn't do anything. They didn't move rates lower or higher. What was more interesting was that during the press conference, Chairman Powell was pressed on if hikes were in the future. So a couple of Fed members had mentioned, given the inflationary data that we saw in the first quarter and in April, that hikes might be warranted, right? Interest rates to go even higher than they are right now. And Chairman Powell basically took that off the table. And while we might not see as many rate cuts as we anticipated in the first quarter, expectations have come down. But at least for now, anyway, Powell said that hikes are not part of the conversation. So further increases in interest rates. Now, the Fed is obviously important because it dictates the cost of capital, right? The cost of the economy running for the financing costs of businesses and consumers alike. But the reason why we said at the outset that it might not be as important as it has in the past is really because of the fiscal deficit spending that we've been doing at the government level. The federal government's been spending, as we've discussed before, a lot more than it takes in taxes. That, in effect, trumps a little bit what the Fed is trying to do with interest rates. As long as the federal government is spending at the rate that they're spending, and we don't see that changing anytime soon, that is stimulus to the economy. And so that, in effect, in a marginal way, trumps what the Fed is doing. So while the Fed is still very important, people still focus on it, and we're going to continue to track it and see what they're doing. The fiscal stimulus changed the picture there. It's something to be aware of. There's lots of talk in the fringes of the market about a fiscal dominant environment. That is where the federal government kind of drives a lot of how the economy is doing and how the markets will respond to that. We don't think any of this is changing anytime soon. Last but not least, this morning on Friday, as we're recording this, we got a Goldilocks jobs number. So the market was expecting something like 240,000 jobs created in the month of April. We got 175. Unemployment rate was expected to be 3.8%, unchanged. It came in at 3.9%. Why is that Goldilocks, right? We created less jobs than expected. Unemployment was a little bit higher than expected. inflation in wages came in a little bit lighter than expected. All of that is considered Goldilocks because what the Fed really wants to see is a slowing job market, which will take pressure off inflation, but hopefully doesn't put the economy into a recession. The market really liked it. It's starting to fade here as the market opened, but it was considered a very good number. It really takes the conversation back to what we were talking about in the first quarter and end of last year, the soft landing scenario where seemingly, at least as of today, it looks like we're able to get inflation down without having millions of people lose their jobs and throwing the country and the economy into a recession. To be seen, these things change and markets move very quickly, narratives change very quickly, and that changes the sentiment in the market. As of this number this morning, stocks were up significantly, bond yields were down, so that means bond prices are up. So again, stocks and bonds moving, together instead of, in uncorrelated fashion. So far so good in terms of how the Fed is managing the economy, so to speak. It looks like the soft landing or no landing scenario is back on the table, even though leading up to this, the focus was very much on inflation and the fact that it was stickier than anticipated. So that's all we got for this week. Again, busy week. We have another busy week next week. We're through with earnings mostly as of this week. We will see you guys next week. And as always, please leave us comments and let us know if you want to discuss any of this in more detail. If there's anything in particular you would like for us to discuss in next week's weekly, please don't hesitate to drop us a line. Have a great weekend.